Welcome to the Future of Supply Chain, presented by Dynamo. Each episode, we sit down with leaders in the industry as we build the future of supply chain together. Let's get into the show. Here's our host, Santosh Sankar.
Hey, ladies and gents, welcome back to the Future Supply Chain Podcast. I'm your host, Santosh Sankar. Joining me today is a longtime friend of the firm, Jake Wieseneck, principal at Maniv. Welcome, Jake. Long time coming here.
Hey, Santosh. No, really glad we made it happen. Thanks so much for having me. Always a great time with the Dynamo team in person, over Zoom, on a podcast. Let's make it happen.
So to start, tell the ladies and gents listening here a bit about Maniv and the platform you all invest from.
Yeah, sure. So Maniv is an early stage investment firm. We've got about 330 million of assets under management. We're co-headquartered between New York and Tel Aviv. And we're investing in what we describe as the deep technologies and business model innovation companies that are decarbonizing and digitizing the movement of people and the movement of goods. Personal mobility, commercial mobility, the transportation sector broadly defined. These concentric circles, shall we say, of the transportation sector and how that intersects with automotive infrastructure, energy, logistics, all these first order impacts that all radiate from these two mega trends, the decarbonization and digitization of transportation. And we're lucky to do that on behalf of a great set of financial institutional limited partners. And most importantly, as I know we'll talk about, in partnership and close coordination with some of the biggest titans of industry within the automotive, transportation, infrastructure, and energy sectors.
Amazing. And, you know, I asked our guests this at the top of every podcast, but what's your story? How did you kind of get into the world of mobility investing and venturing in this world?
Look, Santosh, as I often say to founders when I introduce myself, I'm a planes, trains, and automobiles kid who feels so damn lucky to do what they do day in, day out, in their job. I wasn't a superhero kid. I was Hot Wheels and airport models and all those sorts of things in the basement sort of kid. When I was younger, it's actually funny. I was reminded of the story recently. My dad traveled a ton for work when I was at a young age, and so partly in order to keep up and keep in touch, but also to improve some of my writing skills, which I needed back in kindergarten, first and second grade. We keep up a journal that he would write in, when he gets back late at night or leaves early in the morning about where he's flying to, where he's off to, what planes he's taking, what Virgin Atlantic is flying to London these days. And I would always be super interested and intrigued by those sorts of things. So coming home with London tube maps and safety cards from the back of 737s, those were the sorts of things that I loved at a young age. I got an airport radio from my grandpa as a bar mitzvah gift. And so all that being said, I feel incredibly lucky to have started my career in the investment world over at Apex, doing Series C and beyond enterprise software, consumer internet in the Apex Digital Fund. North Jersey is a small place, and got to know Mike Granoff over the years and felt incredibly lucky to join Maniv about 5 years ago at this point in time.
Amazing. That's amazing. It's in your bones, is really what I'm hearing.
So they say.
So I've had the good fortune, John has had the good fortune of sharing an investment in Celdine with you and the Maniv team. And I'd say we've come to appreciate your potent network, LP basis strategics that you kind of teased and alluded to. But tell us a bit more about that, because I think of all the firms out there, I think you guys do such a great job in having kind of that two-way relationship with those basis supporters that allow you to do what you love to do day in and day out.
Sure. Happy to do so. So foundational in Maniv strategy, kind of from day one in our first fund back towards the middle of the last decade, was building an organization in close partnership with some of the titans of industry, like I mentioned, dating back to Maniv Fund 1. Originally we had the opportunity, as the outgrowth of Mike Granoff, our managing partner's personal network and some of his connections over the years, to engage with a number of the leading automotive players, primarily first OEMs and tier ones, who were particularly interested in this almost weird intersection to look back on over the course of the last decade of the Israeli deep technology sector and the automotive sector. In 2017, 2018, there was just almost bizarre question that was frequently asked within the headquarters of players, whether it be in Detroit, in Paris, in Tokyo, or in Seoul, of what's our Israeli technology strategy, given just the massive prevalence of great deep technology founders coming out of 8100, 8200, two top units in the Israeli military, and looking to apply their trade to the broader transportation sector, primarily in the back of two key trends. electrification, and autonomy. And I'll add one more, also connectivity and the emergence of the vehicle as a connected asset and also a significant cyber threat. And so a lot of our initial focus spun out from that question. How can we on the ground within Israel, where Maniv is originally headquartered, offer preferred access and be an interlocutor between our portfolio companies and the industry that they're selling into? Because I'm going to give up something that's not a secret. The automotive sector is a really hard sector to sell into and to crack the code of. And so as a result, what originally started as working with a select group of limited partners, primarily from the automotive sector, back into our first fund, evolved into a strategy, went out to raise our second fund, $100 million vehicle, lucky to work with 14 different strategics that included a large number of, tier ones and OEMs, but also included our first energy player, our first logistics player, and all the rest. And so that those partnerships morphed our strategy a little bit in really two ways. First off, in terms of the geographic focus of the firm, we began investing a lot more globally on the basis of really strong relationships with corporate strategic partners across Asia, Europe, the United States, and beyond. And also, I go back on this quote that we have from an interaction with one of our automotive OEM LPs at that point in time of, hey, anything that represents a replacement of an automobile trip is the sort of threat to an OEM. And that could either be in terms of a new form factor, lighter weight or heavier weight. It could be in a platform technology. It could be in the emergence of all these consumer applications that represent the trip economy. At its core, those sorts of technologies essentially replace an automotive trip. And so as a result, the relationship with our strategic limited partners really is pretty symbiotic. We look to work with a select number of folks who are particularly acutely interested in what are the threats to the core business of an automotive player, be it a fleet, be it an automotive insurer, be it an infrastructure developer, be it an energy company, be it a car or component manufacturer. And our engagements typically revolve around two fronts, being bidirectional communications, picking the perspectives of our strategic limited partners on the deals that we're evaluating and understanding where they may have assets or perspectives that could be valuable to our investment strategy. And in turn, exchanging significant amounts of deal flow and opportunities that come across our desk, because we often say, Santosh, we see about 2,000 deals a year. We invest in 4 or 5, and it's more likely than not something in the other 1995 that's of greatest interest to our strategic partners, whatever it might be. Yep. And we, by way of having the chance to work with these folks and be in conversations, every interaction that we have then feeds back into incredibly valuable knowledge and perspectives that inform our investment decisions as a firm. So at its core, what it really boils down to is working with a diverse group of limited partners over time who are exposed to all of the key inputs to the transportation economy and how it's going to evolve, and finding ways to benefit from knowledge sharing of each other's processes and see how we can do our best to predict the future together and make some sound investment decisions as well.
Love that. Love that. Thank you for that. I'm going to shift gears here, and we're about halfway through 2025. Sure. It's been a very dynamic year, right? You have team members in Tel Aviv. They've had to kind of live the day-to-day of the conflict in that region. We step back on a macro level. We're in the middle of kind of trade flows being re-architected around the world. And so I shared that or set the scene because I'm curious, what's getting you and the team excited these days? Either kind of where have you allocated your dollars, or where would you like to allocate your dollars based on the good work you do?
Yeah, sure. Great question. And first off, as you said, super dynamic time. And, our thoughts go out to, and, we send immense amounts of strength to founders, investors in the broader network that's been impacted, by the conflict in the Middle East. And lucky to report that the Maniv team and our portfolio is safe and sound on the ground in Israel and chomping at the bit, to keep on keeping on in the day job, as I've said. Look, what's getting us excited in 2025? A lot. Company formation is at all-time highs. Just from evaluating the numbers of deals that are coming across our desk, we're seeing tons of interesting opportunities. And what's also interesting, Santosh, on that note, is we can say whatever we'd like about the U.S. innovation economy. The Maniv team, we receive deal flow globally, and we are at all-time highs from a numbers point of view and in quality as well from the deal flow coming out of the United States. So something's in the water here that's leading to a lot of really interesting company formation in critical sectors that are relevant for Maniv, relevant for Dynamo, and our peer sets. What's getting us excited? I will sound cliche in saying this, but it truly is what's happened, and our investment record shows it, is the intersection of verticalized AI and the mobility sector directly. And I'm not talking about, that in a high level. I'm talking about very acute use cases. I'm talking about what are the different uses of LLMs and agentic AI that can be applied to help transportation businesses run more efficiently. We've made 2 investments to this effect, both of them in stealth currently, one really focusing on maintenance and repair. We're down. No one's going to trade school here in the US and trying to be a mechanic in the same vein as in our parents' generation. United Airlines is down over 40% in terms of the number of mechanics operating at Newark, my hub here that I fly out of all the time. How is it that those individuals are going to operate more efficiently? And are there process logs and potentially even some Copilot features that can be built out to help mechanics operate more efficiently? We have an investment in a company called Robot Toolworks. You'll hear about more soon. That's doing some interesting things on that. And then I can't talk to the Dynamo team without talking about the freight space. And obviously, there's a ton that's happening. There's a ton that's happening in that world as well. A lot of folks that are placing their bets, and we think there's tons of opportunity that remains for folks, particularly in the freight brokerage ecosystem, to take primarily, previously human processes and leverage voice and text agents to that effect. And so those are 2 areas that are getting us excited. I'll add one more, which is you take those applications and you put them into manufacturing. We think of automotive as a litmus test for so many different complex manufacturing industries. I think there's going to be even more capital flowing into the sector. And I'll say that's something that I can tell you, it's getting a lot of our LPs, the OEMs and tier ones, quite excited.
Love that. Love that. And, we both spend part of our lives helping our portfolio companies graduate, get that,
Sure.
Series A that everybody values, prizes under their belt. And I'd be curious, kind of, what are you observing in the Series A market? Are you finding to be that the bar has raised or changed in order to raise what we would call a knockout round? Just kind of curious how you're parsing through those dynamics.
No, it's a great question. It's an interesting one too, because Maniv in our third fund, which is a meaningfully larger fund, is also investing in a select number of Series A's as an entry point. I'm a growth investor by background, so I typically like to go back to the adage of a series is nothing but a letter, right? It's in the eye of the beholder, and it means a lot of things to different people. But if we're talking about, the typical Series A, the $8 to $12 to $15 million round with a good amount of de-risking that's come through it. Here's what I'll say in terms of the expectations that we as Maniv place on founders when reviewing Series A as an entry point, which are the same expectations that we hold our founders to when they go out to market and raise. The first and foremost is product market fit. What does that look like for a consumer application that typically repeat transactions, strong customer cohorts, and in the millions of revenue? In the deep technology side of the equation, that typically means a product where the science risk is passed, customer engagements that you can point to, and ideally some very meaningful contracts. And most importantly, customers that are eager and willing to hop on the phone and sing the praises of the founders and their technologies and the impacts that they have on businesses. I really like that last one because it's a litmus test for investors to think through. Does this team, even if they are in the early innings of revenue, have customers that are willing to get on the phone and engage and meaningfully walk through the impact of that company's technology in the business? That, from my end, is a really good litmus test of whether or not kind of a company is Series A ready. But I'll give kind of 2 words of guidance that we typically give to our founders. And some of these I know are shared between Maniv and Dynamo from the boards we serve on together. The first I'll say is you need to have multiple pathways to success. We want to invest in businesses that have multiple potential business models that they can pursue, multiple potential end markets that they can go after, each of which represent opportunities to deliver, the proverbial venture returns that we always speak of to our limited partners. Optionality is key in a time like this. And the second is a real catch-22 that I often find, especially at the later stages, growth investors frequently place on our portfolio companies as well, which is being able to walk the walk and talk the talk at the same time. What I mean by that is being able to show 2 potential pathways. How a round being raised could, on one end, potentially represent the last round of capital in to a company and be able to tell that story, but equally at the same time, be able to tell the story of how can we leverage significant incremental capital thereafter in order to scale and go after hyper growth. And I think, it's a really tough tightrope to walk for founders. But I think thinking in that framework, how is it that I can, pending on what the markets will permit me, take this company forward in a variety of different roads optionality is the name of the game when it comes to get across that valley of death and raise the Series A.
And if I may, I actually really like kind of how you have described that, but that almost forces you to, by default, have at least two options, if not more.
Correct.
If you kind of think of this could be my last round, or rather, this is just a round that then unlocks future capital at some point.
Sure.
And how have you seen that best narrated? Perhaps, being able to kind of tell the story, but leaving kind of that option open for perhaps another story or another chapter to open. Is there kind of a certain tactic, or maybe folks that you see do it really well over others?
Yeah, it's a good question, Santosh. I mean, we at Maniv, and maybe it's a little bit of the Israeli DNA that kind of runs through the veins of the organization. We opt for transparency above all else. And we encourage our founders to be upfront and transparent with teams about what they feel capable about and what they don't. More often than not, that isn't the tact that's followed. And I think we try to deviate away from that line and kind of push towards transparency at its core. So I encourage founders this effect to be able to say, straight-faced, and most importantly, with a board-backed plan behind it, hey, we have immense optionality pending the preferences of the next lead investor to go down a variety of paths. We can go after, out of the 4 potential end markets, we can pick 2, we can pick 3, we can have a smaller presence in 4 and see how that goes. We can go after the mega round. We can, if we choose to dial that back. It's a very tough market to raise in. And so again, it's all about the greatest number of options you could put on the table to a board, but also to a potential investor in terms of the narrative that they and their team are going to develop internally to gain conviction. And so I encourage founders on this exact tack, Santosh, to be transparent and say, there are a number of different ways that we can run this business. There's a number of different ways that we can approach this round. And if the answer is you're going out with 15, but maybe you can raise 8, hey, we understand going out there for a higher number and shooting for it, but be transparent as those conversations evolve, because investors, and tell me if you agree with this from your vantage point, love to hear founders who have so much control of their business that they know how to take it in different directions. There's a famous quote from United Airlines, former CEO Jeff Smizek, of, I know what it looks like to run an airline at 2 different oil prices, right? They just look like really different airlines, right? And kind of similar thing in terms of the venture world, knowing and having the capacity to run a business with $5 million of capital at Series A or $10 million of capital at Series A, and still have options in terms of how to pursue that business and generate a return for investors. That's what's particularly important in difficult fundraising times like these. But don't get me wrong, Santosh, we're obviously encouraging our founders to shoot for the stars because that's what you got to do in this business that we're in.
Yep. The one thing I'll add, and we can move on from this topic, is sometimes you have to explain this perhaps in more detail. It might take a few conversations to land on a founding team, but you'll oftentimes hear me express and say there are very few things that a founder and investors will align on. Optionality is actually one of those few things.
Completely agree.
So embrace it. Don't let an investor run your business, but show to them, I like equally how you said it, that you have such control and understanding of what you're building that you can take it down a multitude of paths, and a new investor can be a partner that provides that input and that insight perhaps as to maybe which direction you want to push and pull on together.
Yeah, Santosh, if I could add one more thing to that, there's a question I frequently ask founders, which is, what are you looking for and what are you not looking for from an investor? And I ask it in terms of personality traits, right? Because we all know how we interact, the typical sorts of board members that we are, and we want to make sure there's a fit to that effect. But I ask it even more in terms of competencies and connections, because again, I would push founders, and when I serve on boards, I push our founders to think through not just what's the capital on the table, but what's the incremental knowledge or relationship set that you're gaining by bringing that set of folks in? And oftentimes that revolves around optionality. If there's an investor that can be brought to the table that gives you net more optionality in terms of potentially exit outcomes down the line, in terms of business models you can go after based on perspectives that they have, in terms of end markets they can help you with connections into, we are in the business as early stage investors of working at essentially, I like to say, Maniv is a fund that looks essentially to generate alpha based on network and connectivity. That in its own right basically boils down to generating for founders optionality via net new doors that hopefully we can open, running the businesses up to the founder. That's the role that we look to serve. We are practitioners of creating optionality for our founders.
Love that.
I think I love the way that you started putting that, because I think it makes a lot of sense.
So you a few moments ago talked about AI and kind of some of the surface area
Sure.
that you all are excited by, deemed to be investable. I have to ask kind of, I guess, the million or billion dollar question that all VCs are trying to understand and reckon with. What does it mean to be defensible and to have a moat as a company scales and grows in this kind of world of AI? You and I have the benefit of, we also have to deal with the physicality of the real world. There's some benefit to that. But is there kind of a framework? Are there certain things that you're kind of leaning in on, or maybe even have changed in your approach as you learn more about these types of business models?
Yeah, no, really good question. I think in my point of view, it boils down to knowledge of customer and being able to devise workflows that are based on how things work operationally, right? You kind of answered it yourself in terms of we interact with the physical world, right? I'll pick on Toolworks for a second in our portfolio, maintenance and repair operations, particularly when we're talking about 777 jet engines or military grade aircraft, right? Those are the sorts of technologies and the sorts of heavy assets that you can't just walk off the street and devise, process manuals of how to operate on, let alone have the sensitive data as well to do so. And so, from our vantage point at Maniv, the moats that are generated by these businesses are, one, an understanding of operationally how the customer is actually going to interact with technology, which basically boils down to understanding their workflow day in, day out, and also the intricacies of those businesses. I think that's where kind of the moats are going to be derived, which is why I boil down to making sure that the founding teams that are building these businesses come from the sectors that they are building for, because it's that knowledge that's necessary to have the operations of working in a intensive physical world industry that I believe is required in order to go out and devise, essentially figure out how to leverage a new tool, in this case, the tool of LLMs and AI, artificial intelligence broadly defined, in order to apply it to a given sector. That's how we think about it. But I think we are so early in this wave and hype cycle that the proof is in the pudding. As we like to say, we'll know in 10 years how it is that we're doing. But I think early returns are starting to show that thesis is resonating within the investments we've made in the portfolio. But I'm curious about you all as well at Dynamo and how you guys are thinking about that.
So it is just kind of, as you said it, I feel like every week there's a new piece of data or input that we then put into our mosaic and debate. But I think of it in perhaps three areas. Domain. So this goes to, do you actually understand the workflow? How does that interrelate with the adjacent parties that are dependent on you? Maybe you're dependent on them. Does that trigger a movement of a physical asset in some way, shape, or form? How is that architected today? Because the thing that we are oftentimes reminding ourselves and our founders about is we have a certain perspective of the future state, but change is very hard. So if you have domain, you're better disposed to actually leading that shift and helping with the change management that needs to occur. Because the thing that AI is really providing us is we need to rethink how work is practically done. We had confines of text boxes and submit buttons because we were very much a data in, data out. And AI now takes that away. It can just actually undertake the work. But in industries like trucking, warehousing, manufacturing, there's a trust element here. It's going to take time to win the trust of these individuals, whether they're users or decision makers. So we just need to make sure we're not just jumping the gun and saying, this is how the world's going to work. Respect how it's done, respect the domain, understand it, and lead that transition forward. That's the first thing. The second is data, right? What gives you the advantage to have unique data? Data is the asset. And then the third is what I call distribution. And the one thing I feel that becomes clear to me as the weeks go by is the elements of domain and data are very much going to be competed away. Others will come. They're going to pressure you. they're really going to make you fight for that. But distribution, if you can show that you have distribution leadership, and maybe this is why this could predispose some of the incumbents, if they can really capture this technology constructively, to be real fierce competitors in the battlefield. But distribution, I think, is a thing that is going maybe under discussed and under loved that we should pay attention to.
So Santosh, I love that. And I'll throw one question out to the audience as well, which is one thing that we're mulling over as well. You talked about kind of traditional workflows and UI, UX, and how that will need to change in computer interfaces more broadly based on AI. There's another one out there, software business models, right? Are we selling software? And particularly if it's prominent in terms of, if it really at its core boils down to agentic AI functionality. I don't think that should be sold, by the seat going forward. What is the new paradigm for how it is that we price and sell essentially this labor and these efficiencies that are being generated by this technology? That is a key question that we are thinking about, and very intrigued to see how the market responds in this wave 1.0, let alone 2.0 of all this verticalized AI technology. It's an interesting time to be thinking about that.
I will say, and maybe we're speaking from our own book here, the pair of us. I actually am not sure there's a better place to be investing in AI and exploring the business models that best monetize AI than the worlds we dwell in. Because I've said this to our own LPs, that software uptake across supply chain has been very poor because you're not aligning outcomes with the buyer. Buyers don't want large fixed costs. Oftentimes their businesses are variable, aligned to what they are really looking for. And that's where if you charge for the work, you're better suited to align to how their revenue function operates.
Absolutely.
And that's not to say you can't have, high quality revenue or revenue consistency being a SaaS investor in your prior life. You just have to think about contracting a bit deeper. And that's where to your point, domain is so important on a founding team.
Completely agreed. What does, I know one of our advisors we work with always has us think about, how does every stakeholder keep score, right? And I think in this case, as you're alluding to, understanding if you're building a verticalized AI product for a specific industry, especially if it interacts with the physical world where we dwell, how does the customer keep score? What are they motivated for? And how can you build out a contracting model that essentially aligns wins in both sides column? That's interesting. I don't necessarily think that's by the seat SaaS going forward for some of these verticalized AI technologies. Get your popcorn ready. Let's see how it evolves.
Agreed. Shifting gears here from AI to decarbonization.
Let's do it.
We share Celodyne around this subject matter. You're invested in Harbinger as well. But in the US, the landscape around decarbonization and the attitude, even at a policy level, has changed meaningfully in the last year. And I'd be curious, kind of, how do you all think about it? Are you continuing to make investments? Are there certain things you look for now that you didn't look for before? But I feel like this is also kind of a subject that maybe everybody's thinking about, not enough people are talking about.
Call us up. Happy to talk about it all day, any day. Look, Santosh, our point of view on electrification has remained incredibly consistent from day one, which is we view electrification as a kind of in a similar vein to we're talking about AI for more fundamental operational technology. We view electrification as a paradigm shift in the movement of people and the movement of goods in the transportation sector that opens up new financial opportunities for those that are able to develop either technology or business models to take advantage of the benefits that come from electrification. That is not everyone. We are not fundamentalists as it relates to electrification. Electrification makes sense for certain use cases. It does not for all. In the same way that a Lucid with 300, 400 plus miles of range is not an efficient use of battery assets if we think about the world truly from a systems point of view. And so what I'll say is here at Maniv, our paradigm has always been, when we think about decarbonization and we think about electrification in particular, we are looking to invest in teams that have built products or platforms where the cost imperative to electrify is fundamental, where the math checks out in spreadsheets, not in CO2 emissions calculators necessarily. And so Harbinger being a perfect example to that effect. They are going out there and they are selling trucks in market far below what the incumbent OEMs are doing on the diesel as well as the electric side. That makes a fair amount of sense from a cost point of view, let alone performance, to purchase that vehicle. In the form of Celodyne, as we talk about so frequently, their technology and their membrane within fuel cells enables utilization of hydrogen as a fuel in heavy duty trucking, in all different sorts of industrial applications at cost parity to diesel. That's a financial imperative. Our other two recent investments in this space in our third fund have all kind of evolved around how emerging markets represent really interesting ecosystems for a little bit more, outside the box business models around electrification, where the cost paradigm makes sense. That's FreshBus out in India, who basically has built out an all EV, asset heavy, charging heavy bus line, where on the basis of the significant cost benefits in India to operating as an EV operator, they're selling and they're operating actually about 30% cheaper on a per kilometer basis compared to the diesel incumbents. Or Vamo down in Brazil that now has 100 swap stations across Sao Paulo, where again, they're offering couriers an incredibly convenient process to have a vehicle plus energy subscription, again, at cost parity to a traditional leasing platform for a diesel engine. And so that's our fundamental view. If the dollars and cents make sense, that's where it makes sense to electrify. That is not a fundamentalist approach.
Love that. Love that. So stepping back, if we look ahead 5 years, right? So let's say end of the decade, what's a bold prediction that Jake has to share with us?
Bold prediction that Jake has to share: automotive OEMs and tier ones are going to look a lot different. There may be less of them. There may be some consolidation in the industry, but I think fundamental to our belief is that OEMs at their core are fantastic technology and innovation houses who have a lot of competencies in engineering, in manufacturing, and those competencies over time are going to be used in a variety of ways that don't just represent building four-wheeled vehicles in the way that they have in the past. And I think there's a massive opportunity on the back of utilizing some of the many technologies that Santosh we've spoken about for OEMs to leverage their firepower and their balance sheets as well to become a much broader set of technology providers in areas outside of the car. Let's see what that looks like.
I really like that. I mean, my imagination is running wild, but I will come back in 2030 and we were going to talk about that. So.
By all means, same time, same place.
Let's bring us home now. I love to end with what I call rapid fire. I'm going to give you 3 topics. I would love kind of your quick 15-second knee-jerk response.
You got it.
Awesome. Let's kick it off with the impacts of geopolitics on mobility.
Supply chain, mineral sourcing and supply chain. That is a geopolitical question. That is a US-China question. And our friend Robbie Diamond and team at SAFE, Citroen America's Future Energy, will talk your ear off day in, day out about that as well.
Your most important daily habit?
New York sports radio, WFAN. Detoxing, and most importantly, bemoaning the other airplane I care about, the New York Jets.
And finally, your dream car.
Oh, this is easy. My current car, Jeep Grand Cherokee. I'll have one for the rest of my life. Love it.
I love that. I love that. Jake, thank you so much for sharing a bit about how you and the Maniv team think about the world. Equally, what's exciting you here as well. Look forward to seeing you.
You got it, sir. A lot of fun. Look forward to catching you soon. All the best.
Cheers.
Thanks for watching. Follow us at dynamo.vc for all the latest episodes. We'll see you next time.